Now, the deficit with China is the largest and on pace to break last year's all-time high. Joining us for more analysis about the trade deficit, the Chinese economy, is Chandru Rajam, CEO of Richfeedback and professor at George Washington University. Thank you very much for joining us. The trade deficit, we have talked about this deficit over and over and over, and every month it's exactly the same thing. Americans, of course, are importing lots of goods from China, but the import number, is that perhaps a little surprising to you?
Well, I think the dominant trend has remained the same, which is America's import from China of lower-end goods. And I think what we're also noticing in these short-term figures are some trends that should not be confused with longer-term secular trends. Obviously, longer-term trends are driven by comparative advantage between U.S. and China. But the short-term trends clearly have to do with a slowing growth in the Chinese economy, combined with the fact that the U.S. economy has also taken a hit as a result of its trade with Europe. And so I think cheaper oil clearly plays into this, but you know, I think it's important to keep the short-term trends away from the long-term trends.
Remember, there was a time when the United States was quite worried that we'd lose all our jobs to not just China, but to countries who had a more competitive advantage in terms of labor costs. But of course, as you read some of the media articles of late, there are a lot of U.S. companies that are bringing some jobs back, perhaps, others who are renegotiating contracts, whether it's with unions or in the private sector. Is the U.S. becoming more competitive?
Clearly, there are initial signs that the U.S. manufacturing sector is gaining strength. Now, whether this is a blip or a long-term trend remains to be seen, obviously. But the wage differentials are converging, not perhaps as much as we'd like, but clearly we're beginning to see areas of the U.S. that are becoming more competitive, especially non-unionized situations, perhaps in the South and elsewhere, where given the higher productivity of the U.S. worker and the lower nominal wage rates, it is starting to make economic sense for companies to either bring some of the jobs back or locate new investments right here in the U.S.
When you look at the economies on both sides, and you have to analyze the Chinese economy and the U.S. economy, and they're both basically tied at the hip at this point, what do you see happening 1-2 years from now?
Well, I don't think we're going to see a whole lot of changes, again, in the long-term trends in 1 to 2 years. For those kinds of rebalancing to occur, we're going to have to see significant amounts of domestic consumption in China. We're going to have to see export competitiveness in the U.S. gaining sharply. Those trends take time. However, I think in the short run, we will continue to see this sort of anemic growth in the U.S. As well as slowing Chinese growth, continuing to buffet these month-to-month trade numbers. I mean, we have to remember that these numbers tend to be very volatile from month to month simply because of the number of components that sort of feed into the trade balance. So in the short run, I think you're going to see this up-down trend, but again, you know, all against the backdrop of a longer-term trend in which you'll see some manufacturing jobs gaining ground in the U.S., but overall, long-term, I don't see the big secular trend changing.
Okay, Chandru Rajam, I want to thank you very much again for joining us. We'll have more about this later.
Thank you.